Frankly, there's really kind of two stories happening in the marketplace right now. Markets are quite bifurcated. The interest-sensitive reacting markets have been in some type of a slowdown or even a recession over the last, we'll call it 12 to 18 months. We saw leading economic indicators peak almost 2 years ago. Durable goods and other interest-sensitive parts of the economy have slowed down. We've certainly seen earnings at banks modest and frankly declining. And so as a result, what we're seeing is parts of the economy are not in great shape. And yet, and we refer to that as a bit of a rolling recession, and yet the market has continued to perform very well. And we keep pushing off expectations of Fed rate cuts. However, our belief is that we are on pause, that the rates are not going to go back up. And as I mentioned, the quantitative tightening is still happening in the background. And that has a powerful impact in the interest-sensitive areas of the economy. One area that we're particularly thoughtful about and cautious about right now in our rolling recession or cycle type of paradigm that we find ourselves in is commercial real estate in the U.S., in particular office, and the impact that it's going to have in small and mid-sized banks, and also their ability to lend into the small and mid-sized borrower economy or part of the economy in the U.S. I think this will all lend itself to the Fed continuing its view on pause and then ultimately on rates declining.
So, Ann, this is Martin here. They're going to wrap up QT by middle of the year, you reckon. What about the government debt? What about record issuance, though? I mean, that's going to continue putting pressure on yields higher, is it not? And that's going to be going against what the Fed wants to do?
Absolutely. You know, as the investment professionals, we tend to focus on the Fed only, and we tend to ignore, and maybe to our peril, fiscal activity. And the fiscal activity has been very stimulative, and the Fed's had to fight against it. Fiscal spending impulses have been very strong, and they will continue. And in fact, if anything, in 2024, one of the risks that we see is continued fiscal spending, deficit spending, causing the Fed to continue to have to fight against that, if you will. And these impulses then could actually extend out that period of time where the Fed will begin to actually start to lower rates significantly. When they do start to lower rates, and we do anticipate those cuts later this year, we would normally expect the long end of the yield curve to continue to come down. We've been in a trading range on the 10-year Treasury, and we expect that will continue. And that's probably going to range between 3.75 and 4.25. We can go a little higher than 4.25, depending on some of the inflation prints. Again, markets don't move in straight lines. And so as a result, what we would anticipate is we would expect the long end of the curve to come down. However, because of this fiscal spending and because of the need to continue to issue treasuries, that's going to put a floor under the long end of the curve quite significantly. We would not anticipate the 10-year being able to go down below 3.5%, even in a rate-cutting environment.
So the curve is not going to disinvert, is what you're saying?
Well, it will ultimately uninvert. But for the time being, the fact that we continue to have an inverted yield curve is actually putting further pressure on interest-sensitive sectors of the marketplace. And as a result, again, it is actually creating a tightening condition, and real rates are much higher than I think that most market participants anticipate or expect. And I think that's putting pressure right now on, again, those interest-sensitive parts of the marketplace.
Understood.